All right, so the real estate market is in a terrible state. People have a strong desire to purchase a home, but they're unable to do so because mortgage rates are high. Homes are too expensive, and there's not enough inventory to switch things into a full-on buyer's market yet. The encouraging news is that the US has been here before, specifically in 1981, and things did eventually improve. Unfortunately, the housing market in the early 1980s managed to stay healthy thanks to a number of factors that play a much smaller role in today's market, which means that we're going to need to devise a new method of approach to get us out of our current situation or this predicament. So in today's video, I'm going to dive into the lessons that were learned in the 1980s, how things have changed, and our best solutions for moving forward. Stick around. Let's begin by examining the ways in which 2022 is comparable to the early 1980s. The parallels between then and now begin with the generational differences. In 1981, the oldest members of the baby boomer generation were 35 years old, and members of this cohort were in the process of actively purchasing homes. In that year, the first members of the millennial generation were born, and the members of this next generation have been actively looking for homes in recent years. Both generations were hit hard by rapidly rising mortgage rates as a result of a series of rate hikes that were implemented by the Federal Reserve in an effort to combat inflation. When it reached an all-time high of 18.63% in October of 1981, the average interest rate on a 30-year fixed mortgage had risen nearly 5 percentage points in the previous year. Sound a little familiar? When the 30-year fixed mortgage rate reached 7.08% in early November of this year, that represented a 4.1% increase in 1 year's time. The rapid increases in mortgage rates caused many who were considering purchasing a home to pull out of the market. According to historical data that was compiled by the National Association of Realtors, the percentage of year-over-year decline in sales of previously owned homes was 22.3% in 1980. And then another 18.6% in 1981. Again, according to the National Association of Realtors, the rate of sales of previously owned homes fell by 28.4% in the 12 months that ended in October of this year. Finally, rate lock-in. It was a phenomenon that occurred during both eras, in which a homeowner wants to preserve their current mortgage at a lower rate for as long as possible, so they choose to keep their property off the market. In March of 1981, a real estate executive stated to the New York Times that the slowdown in the selling of homes was due to the fact that nobody wanted to lose their low interest mortgage. In September of this year, 2022, Lawrence Yun, who's the chief economist for the National Association of Realtors, said that some homeowners are unwilling to trade up or trade down right now because they've locked in these historical low mortgage rates in recent years. I just bought this place a year ago, have a historically low rate, and yet it's been a challenge to determine whether or not I'm going to sell after considering some relocation ideas. But you can certainly see the similarity in sentiment here. However, despite many parallels between the 1980s and present day, there are some significant differences, and one of these is assumable mortgages, which were widely available back then, but are much harder to come by today. At the beginning of the 1980s, a large number of mortgages were available to be assumed. And when a buyer purchases a home that has an assumable mortgage, not only does the buyer receive possession of the property, but they take over the home loan too that was originally held by the seller. Imagine the difficulty of trying to purchase a home when the interest rates on a mortgage are in the double digits. To bypass the double-digit rates, you track down a seller that had a home who's offering an assumable mortgage with a rate of interest in the single digits instead. And this helps obviously with affordability tremendously. If you're able to take over the existing loan, then that home may be within your price range. But if the interest rate is in the double digits when it may be out of reach, obviously you know which route would lead to more transactions. But in 1982, Congress put a stop to assumable loans. Now, only a small portion of mortgages can be easily taken over right now by another party. Specifically, loans that are insured or guaranteed by the Federal Housing Administration, the Department of Veteran Affairs or VA loans, or the rural housing services of the Department of Agriculture. According to the data collected by the Urban Institute during the second quarter of 2022, together FHA, VA, and USDA loans accounted for around 18% of the amount of mortgages originated during that time period. So less than 1/5 of current mortgages could be taken over by another party. When mortgage rates were sky high, In the early 1980s, assumable loans made it possible to keep home sales from collapsing. Additionally, they really provided the framework for creative financing, which bridged the difference between the purchase price and the assumed mortgage balance. Now, the majority of the time, creative financing came in the form of loans extended by sellers to buyers, for example, in the form of promissory notes for a specific amount that the buyer would pay the seller every month, with the buyer possibly taking out a second mortgage to cover the remaining balance of the purchase price. Now, various names were given to the transaction, including contract for deed, a wraparound mortgage, or a lease option to buy. According to an article that was published in June of 1981 in the Washington Post, creative financing was responsible for more than 50% of all 1981 home resales in many parts of the United States. After more than 40 years, creative financing in the mold of the 1980s isn't making a mainstream comeback, at least not yet. Though the popularity of these creative financing options has waned, they haven't vanished. In fact, they've become more specialized and arguably more creative in the process. We've touched on several of these creative real estate routes on previous videos, from executive lease purchases to subject tos. There are lesser known real estate contract structures that may be incredibly beneficial for these difficult times in the market. I'm going to include a few links to the videos detailing those options in the description below, so be sure to check those out. But even with these types of deals out there, it's unlikely they're going to become mainstream enough to account for half of home resales like they did back in 1981. So the question remains whether some of the creative financing will be the catalyst to aid on the way to recovery. We're going to be sure to keep you informed along the way, so please subscribe if you haven't already and turn on those post notifications so you'll be notified every time we upload a new video. Until we see you on the next one, make it a great day today and keep on cash flowing.